Your house is the biggest bet most people will ever make. The typical American home runs about $420,000 today. You probably assume that price is set by what homes are worth. It is not. It is set by a machine most people never look at. That machine is the cost of money itself. It is mortgage rates, credit, and the loans behind every single sale. It moves about $12 trillion in U.S. mortgage debt, and in 2008, it dropped national home prices 27%. Some cities lost close to 60%. So before you pour your savings into a down payment, you need one number. By the end of this video, you will know exactly what choosing real estate over stocks costs you, in dollars. Welcome to Rigged Numbers, where we expose the financial systems quietly working against you and give you the math to fight back. Subscribe if you want the math, not the hype. Start with the only idea that matters here. It is called compounding. And compounding is simple. Picture a piece of paper that says, your gains earn gains of their own. Your money makes money. Then that new money makes money too. Then it does it again, every year, on its own. That is the whole trick. There is nothing clever hiding underneath it. Compounding is not complicated. What makes it heavy is time. You are not dumb for missing it. The system just never shows you the long version. So let me show it to you now. Over the last 30 years, the S&P 500 returned about 10.3% a year. That figure includes dividends, and we will come back to those. Over that same stretch, U.S. home prices grew about 4.8% a year. These are real, sourced numbers. The stock figure comes from S&P and Fidelity. The housing figure comes from the Case-Shiller National Index. That gap looks small. It is the most expensive small number in your life. Here is the one rule this whole video runs on. A small gap in yearly return becomes a giant gap in final dollars. Time multiplies the gap. It does not add it. Now flip it around. Earn a few points less each year, and you do not lose a little over decades. You lose most of the pile. Same rule, said two ways. Watch it work on a small scale first. Put $10,000 in stocks at 10.3% for 30 years. With no leverage and no extra deposits, it becomes about $190,000. Now put that same $10,000 into home price growth at 4.8%. It becomes about $41,000. Same decade, same dollars in, a $149,000 difference out. Look at what just happened. The stockpile did not end up twice as big. It ended up almost 5 times as big. The gap in the rate was 5.5 points. The gap in the result was $149,000. That is compounding doing its quiet work. A small lever moved a giant weight. Try it as a monthly habit instead of a lump sum. Save $300 a month for 30 years. At the stock rate of 10.3%, you end near $723,000. At the housing rate of 4.8%, you end near $241,000. Same $300. Same 30 years, a $482,000 fork in the road. Now picture that same fork under a real person's life. Hold on to that number. Every disaster and every cost in the rest of this video is that one rule. It is just operating at a larger scale. Keep it in mind as we meet a real buyer. Now connect the rule to the biggest check you will ever write, a mortgage. Consider Brian. He is 35 years old. He has $80,000 saved. He wants a $400,000 house. This is the exact moment the whole decision turns. He thinks he is choosing a home. He is also choosing a return. Brian puts 20% down. That is his $80,000. He borrows $320,000 at 6.5% for 30 years. That 6.5% is roughly today's going rate. His payment is about $2,023 a month, just for principal and interest. That is the baseline scenario. On paper, it looks manageable. The trouble is what the paper leaves out. So run the second scenario, the real one. Over 30 years, that loan costs Brian about $728,000 in total payments. Of that, $408,000 is pure interest. Read that again. He borrowed $320,000 and paid back more than double. The bank's return is the first thing eating his. Now the third scenario. Add the costs nobody quotes him at the closing table. Property tax, insurance, and repairs. Call it $10,000 a year, which is on the low side for a $400,000 home. Over 30 years, that is roughly $306,000 more. and none of it builds a dollar of equity. It is just the rent you pay to the house. Add the three layers up: down payment, interest, and carrying costs. Brian spends about $1,114,000 to own this one house over 30 years. So what does he get back for it? If home prices grow at the historical 4.8%, his house keeps pace. By year 30, it is worth about $1,632,000. That feels like a clear win. Then you run the other road. Look at the monthly picture too. Brian's all-in cost is about $2,856 a month in year 1. A similar home nearby rents for about $2,170 a month. So owning costs him roughly $685 more every month at the start. Rents do rise over time while his loan payment stays fixed, so that gap shrinks and later it flips. But for years, owning is the pricier seat. Now say Brian rents instead of buying. He takes that same $80,000 and puts it in a low-cost index fund. At 10.3%, the down payment alone grows to about $1,516,000 in 30 years. He never lifted a hammer, he never paid a property tax, he never wrote a check to a roofer. So the house wins on paper, but only by about $116,000. And it only wins because the bank fronted $320,000 of the bet. Strip out the costs and look at what the house quietly charged. The house handed Brian a $714,000 bill in interest and upkeep. It never once mailed him an invoice. Now for the advice you have heard your entire life. A house is the safest investment there is. Renting is throwing money away. Real estate only goes up. It sounds like plain common sense. In one specific stretch of years, it was a trap that ruined people. Go back to 2006 through 2012. National home prices fell about 27%. In Las Vegas and Phoenix, they fell close to 60%. Now remember that Brian put 20% down. A 27% price drop does not trim his equity by 27%. It erases all of it. Then it leaves him owing more on the loan than the house is even worth. That is the part the slogan never warns you about. Leverage is a seatbelt bolted to the same crash. On the way up, it pulls your gains faster. That part feels great. On the way down, it will not let go. The same bolt that lifted you now pins you. And the scale of that crash is hard to picture. It was the worst housing collapse since the 1930s. Not the 1970s, the 1930s. Nearly 4 million families lost homes to foreclosure. The number that separated the survivors from the casualties had a name. It is loan to value. That is just how much of the house was borrowed money instead of your own. The more you borrowed, the harder you fell. Let me put a face on it. Take Dana. She bought a $400,000 condo in 2006 with 5% down. Her equity was $20,000. Prices in her market fell 40%. Her condo dropped to $240,000 while she still owed $380,000. Her $20,000 of equity became negative $140,000. So she walked away and lost it all. Not everyone got crushed though, and that matters. The buyers who put more down and refused to sell mostly made it. A buyer with 30% down could absorb the 27% drop and wait. By about 2017, the national index was whole again. Leverage only ruins you if you are forced to sell at the bottom. Now compare that to stocks in the very same crash. The S&P 500 dropped about 38% in 2008. That hurt, and nobody felt safe. But the index climbed back to a new high by 2013. National home prices did not recover their old peak until about 2017. Stocks fell faster and healed faster. Housing fell slower and stayed down longer. Safe was not safe. It was just slower to show you the bill. Now let me open the hood and show you the gauges. There are 4 worth knowing. The first one hides inside that stock number. The 10.3% is total return. Most of it comes from dividends being reinvested. A dividend is just cash a company mails you for owning a share. You use that cash to buy more shares, and those shares pay you too. Here is the size of it. $10,000 in stocks 30 years ago with dividends reinvested is about $190,000 today. Take those dividends as cash and spend them, and you land closer to $95,000. Skip that one step, and you cut your result almost in half. The reinvesting is the engine, not the dividend itself. The second gauge belongs to real estate. It is the price-to-rent ratio. It is just the home price divided by one full year of rent on the same place. A $400,000 home that rents for $26,000 a year sits at about 15. Below 15, owning usually wins. Above 21, owning usually loses to renting. In the priciest coastal cities, that number has run above 25. In much of the Midwest, it sits closer to 12. It is the closest thing housing has to a price tag you can read in advance. The third gauge is the exit. Selling a house costs about 6% in commissions and fees. On a $400,000 home, that is $24,000 gone the day you hand over the keys. Selling an index fund costs almost nothing, and the cash clears in about 2 days. And speed matters as much as cost. A house can sit on the market for months. In 2008, some sellers waited years for any offer. A stock sells in seconds. When you need cash in a hurry, that gap is the whole game. The fourth gauge is concentration. A house is one bet on one street in one town. If that town loses an employer, your home value and your job can fall together. An index fund spreads the same dollars across 500 companies. One roof versus 500 roofs. That is not a small difference when a storm hits. Now, the part that predicts better than the experts. S&P keeps a public scorecard on professional fund managers. Over the last 20 years, about 9 in 10 active stock funds lost to the plain index. 9 out of 10. The boring do-nothing fund beat the highly paid stock pickers year after year for 2 decades. You do not need to be brilliant, you need to be cheap and patient. And each gauge is really the same rule from the start. Fees and costs and gaps all compound. A 1% yearly fund fee does not sound like much. But over 30 years, it can quietly eat about a quarter of your money. The fee compounds against you exactly the way returns compound for you. Taxes bend the picture too, and they bend both ways. Sell stocks held over a year, and most people pay 15% on the gain. Hold them in a 401k or an IRA, and they compound with no yearly tax at all. Real estate answers back with its own break. Sell your main home, and a married couple can take $500,000 of gain tax-free. A single owner can take $250,000. So housing is not naked here. It just pays property tax every year to get there. Let me be fair to real estate, because the data is fair to it. A home is forced savings. You pay it down whether you feel like it or not. You also live inside the asset while it works for you. That saved rent is a real return the price charts never show. And leverage, when prices rise and you hold on, can turn a small down payment into real wealth. Housing is not a bad bet. It is a concentrated, costly, and hard-to-sell one. Most people simply never count the costs. So what do you actually do today? 4 moves. Each one is a number you can look up this afternoon. Move 1. Look up your own Metro's price-to-rent ratio. Above 21, lean toward renting and investing the difference. Below 15, buying likely comes out ahead. That single ratio replaces 100 arguments at the dinner table. Move 2. Check the expense ratio on every fund you own. Aim for something under 0.10%. Remember the math we just did. A 1% fee can cost you a quarter of your gains over a career. Picture it in cash. On a $500,000 portfolio, 1% is $5,000 a year. Every year, in good markets and bad. Move 3. If you do buy, treat the house as shelter first and an investment second. Keep funding a low-cost, broad index account anyway. Do not let the mortgage become your only retirement plan. Owning a home and owning stocks is not an either-or. Move 4. Run the real rent versus buy math with your own numbers. Use your rent, your price, and today's rate near 6.5%. Do not run on a slogan you got from an uncle. Run on your figures instead. Now return to Brian one last time. The default Brian pours every spare dollar into the house and skips investing entirely. The smart Brian buys a slightly cheaper home. He still puts 20% down. Then he also invests $500 a month on the side. Over 30 years, that $500 a month at 10.3% grows to about $1,112,000. Same salary, same Brian. One habit. One Brian retires with a paid-off house and nothing else. The other retires with a paid-off house and $1,200,000 sitting beside it. The only difference was a second account and a little patience. Here is the truth sitting under all of it. Compounding is a tide, not a wave. You never catch it moving. Then you look up one day and the whole beach is gone. The gap between 4.8% and 10.3% is quiet. It does not make the news. It is also the loudest number in your financial life. So what does 30 years of data actually show? Stocks did not win because they were exciting. They won because they compounded faster and charged you less to hold them. Real estate is not the villain here. It is a fine asset with a long list of costs that people refuse to add up. The honest verdict is not house versus stocks. It is leverage, costs, and time. Win those three, and the asset almost takes care of itself. Lose them, and no asset will save you. The people who understand this are not smarter than you. They just stopped pretending it was boring. That is the only edge they have over you, and it is an edge you can take today, for free. Do this once, and you stop guessing. You start deciding with numbers instead of slogans. That is the whole point of this channel. We built a calculator that runs these exact numbers on your own situation. It uses your rent, your price, and your real mortgage rate. It shows you the rent versus buy line for your life in about a minute. The link is waiting in the description below. Run your own city before you sign anything. It is free to use. Like this video if it connected the dots for you. Subscribe for the next one. We will keep handing you the math to fight back.